Thanks so much for joining us for a very important topic, measuring impact in listed equities, and not only measuring impact, measuring positive impact in listed equities. This is a very big topic and one that's very close to my heart. But just to start by introducing myself, I'm Sam, founder and CEO at Net Purpose. We are a platform for sustainable and impact investors with a real pure mission to help mobilize trillions of dollars to invest in achieving the sustainable development goals. I'm personally very excited about this session today because this is a big topic, as I mentioned, and I'm really honored to be joined by Seb Beloe from WHEB. Seb, I'm going to introduce you and let you introduce yourself in just a minute, but really excited for this conversation and to create a conversation around this topic and to get into some of the meat of this topic. And hopefully we'll let everyone walk away with some actionable insights and thoughts that you can take away into your roles going forward. So just to say before we jump in, this is an hour of our time and we're honored that you've chosen to spend it with us. We do hope that at the end of this session, you can walk away with some new thoughts or evolved thinking on mental models for how to think about positive impact in listed equities. We're also going to get into some of the technical weeds, talking about how we identify and measure positive impact in listed equities and some of the challenges associated with measurement, not only through building theories of change, but also thinking about data availability and what does not exist in listed equities and also what's possible. And then we're definitely going to close with a heads up on where we think a lot of this is moving. There's some great advances happening in standards around the world today on this topic, both from a regulatory point of view, but also just from a methodological standard point of view, in particular, as we think about measuring CO2 emissions avoided. So we're going to jump into some of those topics as well. We do have a lot of people on the phone today. We're excited to be with you. Please, if you have any questions, drop them in the chat and we will try and make this as interactive as possible. We are going to have a conversation on this topic. We're not going to be presenting a whole host of slides. So really excited to get that started. So just to kick us in, I might first start by saying this topic is really important for a number of reasons. As someone who's been in the impact investing space for a while, in my role as head of impact at Leapfrog Investments, we invested in private markets and we're very focused on measuring impact in private market investments and also really focused on helping build the standards and the industry around how to measure impact with the Global Impact Investing Network and other industry organizations. The topic of positive impact in listed equities was always a big unknown topic, I think, which is why we're so excited to dive into this today. But I think fundamentally, we have enormous global challenges to solve, and we must mobilize trillions of dollars to achieve the Sustainable Development Goals. Private markets is a very small slice of the entire capital system. So when we're talking about listed equities and listed markets in general, we're really talking about mobilizing 60 to 70% of all global capital towards measurable, positive social and environmental outcomes and impact. So with that said, I will say I'm really excited, Seb, to have a conversation with you on this topic today. And before I ask you to introduce yourself, I will just say, for those of you who don't know, you're probably in the minority. Most of you will know Seb or have heard of the strategy that he is working on at WHEB. Seb is someone that has led a lot of thinking on this topic for many of us around the room, and personally, someone who I've looked up to and admired the work of for many years in listed markets. I'm also excited, Seb, because you've just released your impact report and sustainability report for your strategies this year. And congratulations, I think you just won Best Sustainability Report for your category in 2023 Sustainable Investment Awards. So it's a really exciting time, I imagine, and also a great time to hear from you on this call. So I'll pause and actually hand over to you, Seb, to introduce yourself. Welcome, and really excited to jump in.
Thank you very much, Sam. It's very kind, and yes, we were very pleased to win that award. It's always nice to get sort of acknowledgement from sort of the third party for all the work that we do. So that was great. Good afternoon, good morning, everybody. So yes, I'm Seb Beloe. I'm a partner and head of research at a business called WHEB Asset Management. I mean, just very quickly on WHEB. So we are an asset management business. We run about 1.4 billion sterling under management. It's all invested in businesses that have a positive impact through the products and services that they sell. We have a global strategy and we have a European strategy as well, and we're a team of about 20. I've been at WHEB for just over 11 years now in that role, and before that I worked briefly at Henderson Global Investors for 4 years as head of SRI research. We don't really hear that acronym very much anymore. SRI, Sustainable and Responsible Investment, was what it used to stand for. And then before that, I worked as a consultant in a company called Sustainability, which was set up by a guy called John Elkington. So spent 10 years working there in the UK and the US. And my background is very much in sustainability and environmental science and technology. I have 2 degrees in environmental science and technology. So I'm a kind of, I've been in finance for 14 years now, so I feel somewhat a financial person, but my heart really is still very much in the sustainability world, and trying to bring that into finance with sort of authenticity and impact. So is that okay? Is there an introduction?
That's perfect. Thanks, Seb. Awesome. So I'm going to jump in and ask you a couple of questions on your strategy and also how you think about positive impact in listed equities. So maybe just to start, to set the foundation, can you tell us a little bit, Seb, about WHEB, about what you're out to achieve, and maybe just a few sound bites on the strategies that you're running, just to give the audience a bit of perspective on where you're coming from?
Sure, yeah. I mean, we used to have a slide in our kind of standard presentation that talked about the 6th industrial revolution. I don't know if you've seen that slide. It was one that FTSE used to use, and Carlota Perez was the original inspiration for this idea that we've had a series of industrial revolutions over time, and we're now embarking on this 6th industrial revolution, which is all about the transition to a zero carbon and more sustainable economy. And the reason we used that slide was it was kind of reassuring for people. Something as weird as WHEB in terms of what we were trying to do, if we could position it as actually, well, this is just the latest iteration. It's a bit different, but we've seen it before. Creative destruction and all that, and for a long time that was quite helpful. I don't think we need it anymore, because I think people kind of understand that now and don't need to be kind of told about it. But the point of our strategy, and really it's a one core strategy, it's all about giving our clients exposure to the companies that are enabling the transition to happen through the products and services that they sell. And by enabling it, they benefit from that. They see growth and demand for their products and services, because those are the things that are helping the economy transition. So really, that's what we're trying to do. And our milieu, our asset class is listed equities. You can do it in other ways, but that's where we focus. And yeah, we have a variety of themes that we focus on, but it's really ultimately it's about the products and services and how they're delivering change, positive change from a social or an environmental point of view.
Fabulous. Thanks, Seb. And actually, this is probably a good segue just to open up this kind of mental model part of the conversation. So you've mentioned products and services here, and I just wanted to say to the audience that I think the topic of positive impact in listed equities is one that holds a lot of promise. Because I think a lot of people throughout their strategies will be allocating, even myself, my pension fund and others, a lot of assets into listed equities, fixed income, etc. And I would like to believe that I can have a positive impact in those asset classes. It's also an interesting topic because it's not the global impact investing network has come more from a private markets lens and has moved now into fully recognizing and embracing the impact possible in listed equities. But we're really just starting to tease apart how you can actually achieve that. So I just wanted to frame what you've just said and underscore that the thesis is to invest in companies that through their products and services can impact the world and solve social and environmental challenges in a positive way. Yeah. And do you want to talk a bit more about, so products and services, and you're very good at, so one of your premises in your report and overall is radical transparency. And I think a lot of us could learn a lot from just reading the report that you've just released. Do you want to talk a little bit more about how you think about enterprise impact versus investor impact and contribution, etc., so that we can get a sense for how you think about that?
Yeah, and maybe just before I do that, I was just there were a couple of thoughts that just occurred to me as you were speaking there, Sam, and I think it's just worth perhaps just pausing for a second, because you're emphasising that it's possible to have positive impact through listed equities, and that's for some people maybe that's a novel idea. I guess there are two things that I wanted to say about on that point, really. One was how it's kind of, I think it's a bit perverse that we have spent so much time talking about operational impacts and kind of focused very much on the operations of a business without actually really thinking too much about the products and services that they sell. ESG, whatever really that means, but for me, ESG is really about the operations of a business. And I think there's probably a PhD thesis in this, but I think the reason for that is the original focus of attention was on businesses that had real problems in their operations, chemicals, oil and gas. And so the focus was very much on those businesses, and they responded with environmental reports and built a narrative around how they were reducing health and safety incidents and so on. So the whole sort of sector set out on this trajectory around ESG and didn't really think about products and services, or at least didn't think about the positive impacts of products and services. We certainly had negative criteria. And that was the other thing I just wanted to say, because I think it's really interesting how people feel perfectly comfortable making a point about if you own an oil and gas company, you have some responsibility for the activities of that oil and gas company. And people, we talk about that a lot, and about, is it right that people own oil and gas companies? And if they do, what should they do about it? How should they engage? And yet the inverse seems not to be as intuitive for people, that by owning companies that have a positive impact, you don't, I would argue it's exactly the same. It's just positive. And investors have a relationship with that positive impact. But for some reason, and I think we see it across different, it's obviously it's a feature of the human condition in some way that we have that bias, but I think it is a bias. It should be equivalent, those two things. So yeah, I hope that's okay, but just two kind of things that occurred to me as you were speaking then.
Yeah, that's actually fabulous. And maybe just to double click on that a bit too, I do think one of the advances recently that's happened is the FCA and other regulators around the world have started to try to segment how you can invest sustainably across a whole host of asset classes. And I think this concept of positive impact is becoming more nuanced. And I think your strategy, backing positive companies with products and services that positively contribute to global goals, has become very well recognized in in those frameworks. I think there are other opportunities, as you say, too, to have a positive impact in a different way if you can reduce your negative. And yes, I agree. For some reason, we've seemed to focus more on that in listed markets, but there are still opportunities to invest positively from a product and service point of view too. Yeah. Fabulous.
So you asked a question about enterprise impact and investor contribution. Shall I just explain a bit more about what we mean by that? Yeah, so this is something that we weren't the first to come up with it. We wrote a white paper though on this idea and how we think about how you can have an impact, a positive impact through listed equities, and very much concluded that these two aspects were really important if you wanted to make a compelling case for the positive impact that you deliver as an investor. So there are these two components to it, we believe. The first is what we've called the enterprise impact, and really that's about the intentionality of us as investors to identify companies that have a positive impact on social and environmental issues through their products and services. We intentionally invest in those businesses, and the impact is delivered by the products and services that those companies sell. So we're very clear that that isn't our impact. We are aligned with that impact. We talk about being associated with that impact. We're investors in these companies, so we do have a relationship with it, but the impact is really owned by the company, or more likely by the customer of that company. So, Vestas makes wind turbines. They sell those wind turbines to utilities. They generate the electricity, and they're the ones that are delivering low carbon power. So, so even Vestas perhaps doesn't own that impact. They're just enabling it. But nonetheless, we think it's really important. It's something that's, it's the key reason really our investors invest with us, is because they want to see this, their capital going into supporting these businesses. And we measure, and using, the wonderful platform that you're putting together, we measure that impact and then report it back to our clients, and we use it in our own monitoring of our portfolio. So that's the enterprise impact. And then separately, we think we can also have an impact directly as WHEB, through the work that we do, engaging with those businesses, encouraging them to mitigate the negative impacts that are inevitably associated with their activities, engaging with policymakers and standard setters, signaling as well around the businesses that we own. So there's lots that we can do as a business to support the work that our companies are doing that we're investing in, but they are distinct, we think. So that's why we've given them different names and think about them differently.
Thanks, Seb. And actually, that's great. The reason I kind of point that out and kind of ask you to define it is, I think a lot of people struggle sometimes with the concept of additionality in listed equities, because we call them secondary markets or ability to trade, etc. But there's a lot of work that you and team are doing on the engagement side, and through multiple other initiatives with the industry and others, as you described, that I think fit squarely into how the IFC or the Global Impact Investing Network would define intentionality of pursuing investments, but also active additionality as an investor, which, as you say in your report, is key to being an impact investor.
Yeah, I mean, we do. I have to say, I don't really like the term additionality.
Yeah.
I think that it promises a lot, more than really most, probably all commercial investors can deliver. The strict definition of it is, that this impact wouldn't happen but for you, the singular investor that's found this investment. And almost by definition, commercial, rate of return investments will have more than one investor that are willing to make that investment. So additionality is problematic. I mean, I wouldn't say it never exists, but it's pretty vanishingly rare. And it's brilliant. I mean, when it does exist, I mean, absolutely to be celebrated, but it's such a tiny part of the market that I don't think it's really a very helpful kind of concept. So we talk about contribution, which is a bit more flexible. I think it's fair to say. We just within the engagement work that we do, we're very careful not to claim responsibility for company decisions to change their policies on key issues. And in many ways, we would argue that if they were doing it just because WHEB were telling them to, it's probably not a particularly good decision. So we absolutely want to share that success with other investors and other stakeholders who are pushing companies to move forward. So it's anyway. So I think additionality is a bit of a red herring, and ideally we wouldn't really use it as a term and focus more on contribution, I think. Awesome,
thank you. And actually, thanks for making that distinction. Something that you said in our preparatory chat also resonated, where I'm going to paraphrase and you're going to correct me, but by definition in capital markets, there's a market. So there's multiple participants looking to allocate capital to any one business. And then in private markets as well, we found that every deal is mostly competitive. So it's not only your capital that could potentially fund that impact. But I think it's a nice distinction. It's a nice definition in the listed equities context. We've got a couple of questions coming through. What I'm going to do is keep going and try and pick up these questions, and then we're going to open up for some of these general questions in just a few minutes. So, Seb, let's jump into how and why we think about measurement. Maybe let's start with the why. Why is it important to measure your impact? And maybe link to that, your clients, I assume, they're allocating capital to WHEB to manage, to invest. What do they want to know about the impact of their investments? And does that drive why measurement is important?
Yeah, that's a good question. I guess our clients very much appreciate the transparency that we provide, not just around the impact reporting that we do, but also the wider kind of ESG reporting and engagement we do, and what we do as a business as well at WHEB. But I think the singular most important reason that they invest with us is because, for most of our investors, is because they want to be invested in companies that are making the world greener, healthier, safer, and equally, I think are comfortable benefiting themselves from those activities, generating a financial return from companies that are doing good things, and equally do not want to be benefiting from companies that are doing bad things. So I think there's that whole package of motivations really that our clients have, and we need to provide data points back to them to demonstrate that we are investing in the way that they expect us to. So obviously we have a lot of data around the areas that we don't invest in the thresholds that we have, in the screens that we have, but we also want to be able to show them that their money is going into companies that are doing actively positive things as well. And so the data that we used to collect ourselves from the different portfolio companies that we own, and now that we do largely through your platform, provides them with some data points that allow them to that back up the proposition that we have for them. So there's there's definitely a reporting component to it, which is really important to us, and I think also to our clients. But it goes beyond that, because we are using the data not just for reporting, but also to help us with our own investment decision making and stock selection as well. So we have a tool that we use within WHEB called the Impact Engine, which is a rather grand title perhaps, but it's trying to collect information across the different dimensions of impact. So things like, maybe we can get into this some more, but how much of an improvement does a particular product deliver in terms of reducing greenhouse gas emissions, or increasing circularity of materials, improving healthcare outcomes. There's an improvement from a baseline that a new product will deliver. Questions around who's the beneficiary? Are these people who are already well served, already have a range of different products that can help them address this particular challenge, or are they communities that have never had the opportunity to access these kinds of solutions? How unique is it? Is this the only company that has this technology? So there's a whole range of different dimensions, and we use that data to help us in our stock selection process as well. So it's not just a reporting thing; it's also an investment decision-making tool as well.
Thank you. And actually, as you're talking, I'm just looking at some of these questions that relate a little bit to this how. So could you, Seb, the concept of a theory of change is coming up. What is a theory of change to you? How do you embed it into your approach? And how does it influence what you measure?
Yeah, thank you. And I'm really pleased that's come up, because I think it's a really important idea, and it's very much part of the GIN's guidance. If people have had a chance to read that, or if they haven't, they should definitely look at it, the GIN guidance on impact investing in listed equities. It's also something that I'm on the technical committee for. The British Standards Institute is doing a standard on sustainable investment, and they're a bit I don't know, they're a bit in two minds as to whether to include theory of change, because they say it sounds so jargony, which I guess it does, but I really hope that it becomes common parlance, because I think it is so important. And what we mean by it is, for every investment that we have, and across the portfolio as a whole, we have identified a series of problems that we need to solve, whether that's reducing greenhouse gas emissions from power production, whether it's around increasing circularity in the economy, solving healthcare challenges. There's a set of problems that we can define at a high level and then increasing kind of specificity. And what we're trying to do is find companies that have products and services that solve those problems. And the theory of change is really the logic that connects the problem or the solution with the problem. And we think that as investors, and really we think all impact investors should be able and should have to set out that theory of change for the investments that they make. And I think they should make those public as well. But at least in principle, in order to be an impact investor, you really need to have a theory of change in order to justify the investments that you make.
Fabulous. And actually that, I think it's a really important concept too, and maybe just a couple of words from my point of view. One is, I agree. I think it should be widely recognized. And I think it actually, one of the positive things with the FCA guidance around the sustainable impact category is the official recognition that you really do need a theory of change to articulate why a given investment contributes positively to a sustainable development goal. What I've also found in the decade or so I've been working in the space is that it actually helps demystify a lot of the talk around why a company is or is not impactful, because it's not as obvious as measuring revenue or EBITDA on a quarterly basis. You really do need to step down into the products or services that a company provides. Those products and services don't necessarily equal impact on their own. We theorize, or we have a thesis that that product or service will be used in a certain way, and that certain way will have a particular measurable impact. And I think unless you get to that level of detail, it's actually quite hard from an investment committee point of view or an investment decision-making point of view to know whether, and have high conviction, I guess, in the impact of the investment that you're making. I think the problem with it in the past has been that it has been a bit of, well, I guess the concept was developed in I guess social circles. There's a bunch of papers on it, etc., more so than the commercial like investment management industry. And I think mixing the language and bringing it down to a practical tool for investors has been part of the challenge, but I think that we're definitely making it there.
No, but it's definitely, I think for some of the investments we make, it's kind of, the theory of change has always been there, but it's just implicit, and it's been helpful to be more explicit about it. How does this particular product connect with this particular problem? But in some cases it can be quite challenging to draw those connections, and the data that sits behind it can also be difficult to conceptualize, let alone to actually to report for a company. So we invest in a company, just to give you an example, a company called MSA Safety that makes equipment for one of their largest products is self-contained breathing apparatus for firefighters. Obviously very helpful in saving lives and burning buildings, increasingly helpful in also fighting fires in the natural environment due to climate change. So I don't think anyone would question the positive impact of breathing apparatus for firefighters, but it's quite difficult to locate what the impact measure should be for that business. Presumably ultimately it's saved lives, but it's so you can kind of get there, but at least conceptually, but how do you measure that? And the company is quite reluctant to kind of disclose, because it's not really them that's saving lives, it's the firefighters, and they don't really want to take any credit for it. So the theory exists the theory of change exists in theory. In practice, kind of populating it with numbers can be a bit more problematic.
Great segue into the next topic of how to do this, and data and disclosure, etc. If we pick up on that example, actually, Seb, I guess just to call out, the ambition really with the theory of change is to, and maybe just to take a step back, the theory of change for everyone listening in seeks to specify a logic chain of how a given product or service or company is having an impact. Typical steps in the chain include an output, an outcome, and an impact. And what we found at Net Purpose is it's not classic, because you don't always have 3 steps in the chain. You might have like 5 if it's an indirect provider, or 2 if it's really close to the end impact. And so we actually now, on our platform for all the companies that we cover with a theory of change and with the calculations on impact and outcomes, have multiple outcomes as we step down for some, depending on the science and the literature. How do you pull this together? And maybe the answer is you do it in partnership with us now, which I can jump in and talk about, but how was it done prior, and what are you trying, what's your assessment of what data exists and what's quite hard about it?
Yeah, I mean, I think I think the way to think about this is that, and it's a sort of euphemism that people often use, I think often to sort of suggest that they haven't done very much, but people talk about being on a journey, and people generally talk about being on a journey when they're at the start, because they don't know what to say. So I always slightly red flags go up when a company says, well, we're on a journey on this, and then they say, we're just setting up the measurement systems or something. But, in terms of impact measurement, we are definitely on a journey. We've come quite a long way already, I would say. From the days when we originally started this sort of 7 years ago, we were scratching around trying to find companies that were reporting data themselves. And frankly, if they reported the data points, we were just, enormously enthusiastic about it, no matter how that data point had been kind of put together, to be honest. And then over the years, we've become much more demanding. We had our data before we started using net purpose data. Before you existed, actually, we were getting our data reviewed by a third party, by the Carbon Trust. So there was more rigor in the way that we were putting that data together. They required us to see a methodology from the company in the last data round. So we couldn't just report a data point. We needed to see the methodology that sat behind it. So it's definitely got firmer. I think with you guys getting involved, and and there are others as well. But as a community, we are now setting standards around this, and there was a really good report that people should have a look at from the WBCSD and from a consulting firm called Carbon 4. Really good report that goes right into the detail of baselines and how we think about counterfactuals, and should you be using the average performance of a product on the market as the baseline, or can you use the performance of the product that you were currently using before you had it replaced? And there's sort of rules as to when you should use one and not the other. So we are getting quite good at it now, I think, and these standards are beginning to emerge. I can't remember the question that you asked now, but it was we have made a lot of progress from the Wild West to a system where we are now really bottoming out some of these key questions and building the frameworks for standards, if not yet the standards themselves.
Yeah, absolutely, Seb. And actually, I'm just looking at the questions coming in too, and we might take a step up and then a step deeper. So the step up would be, just to demystify this for people on the phone. We do, this is a complex topic, but I personally feel like we've made a lot of progress. And I think companies today, actually, maybe just take a step back. I think when people think this is too hard, a lot of funds stop at revenue. We know that products and services are important, and therefore we're going to measure how much revenue comes from those products and services, which isn't an indicator of the actual impact, but it is certainly an indicator of the materiality of the product to the company itself. I think often we've thought it's maybe not possible to go beyond that, but I just wanted to say that it certainly is. And companies today are disclosing more than ever. We have actually very good data on outputs and outcomes associated with products and services across a number of themes, including financial inclusion, healthcare, clean energy generation, and affordable housing and other social themes. I think where sometimes the data is less usable instantly is in the climate themes, the circular economy themes, the water themes, where the actual product itself is quite variable. And so you might get reported by companies the number of vehicles, electric vehicles that were shipped, or the number of burgers delivered, or the number of smart water meters, etc. And it's hard to turn that into what is the impact of that on water usage around the world. So I think it's actually it feels quite possible today to go to that level. I think the hard bit in our mind, where we've invested a lot of time, is in matching that with science that actually validates what the impact of the individual product or service is on the problem we're trying to solve. So getting from burgers or vehicles to CO2 avoided is a leap that we can take. And as you say, we're taking, and there's better guidance around how to take those leaps now. But I just wanted to say for everyone around that it is possible. And, you know, we've aggregated hundreds of literature studies around the world on different solutions that map to the SDGs and regulation around the world and match that to companies such that it's not too hard to start, would be one suggestion. I think then to step a level deeper, one of the questions coming up is, how do you think about value chain impact? And actually it came up when you talked about Vestas. So Vestas is a provider of turbines, not of operating the actual turbines themselves. Electric vehicles, one of the questions is, if you look at critical minerals needed to support the emergence of electric vehicles, it seems that in many cases, the electric vehicle company is receiving the positive impact, not the mining company, which is interesting in itself. How are you thinking about value chain, Seb?
Yeah, it's a very good question. And to be honest, I don't have a, you know, a kind of silver bullet of an answer to it. I think we're still, you know, as a community, I think we're working on how we attribute impact across the value chain. I think from WHEB's perspective, there are kind of two things to bear in mind. The first is that if you're in the value chain, then you're definitely delivering a positive impact. That would be the first point that I would make. You are a lithium miner, and that lithium is ending up in batteries that are used in electric vehicles, then you're having a positive impact through the supply of that lithium. And you know, from our perspective, you should absolutely be investable. You're part of the value chain. It's a subtlety that I think, unfortunately, the taxonomies that we've seen spring up, particularly the EU taxonomies, haven't really properly understood that, which is a real oversight, I think. So that's the first point to make. The second point to make is that while we haven't attempted to, and I'm sure in that purpose you've got an answer to this as well, but we've not tried to go into the attribution. We've always thought of this as a bit like scope 3, really, where you're not trying to, you know, scope 3 greenhouse gas emissions, where you're not trying to ensure that the numbers all add up to the total emissions on the planet. Some scope 3 emissions is someone else scope 1 and 2. So we're not trying to be very clever about how we attribute across the value chain. We're actually kind of attributing full value to any part of that value chain, unless we know that we're investing in two companies that are one is supplying the other, in which case we will then account for that. The other way we think about this, though, from an investment point of view, isn't really about the numbers. It's what we call the centrality. How central is the company's product to the impact that's being delivered, or the outcome that's, you know, the impact that's being delivered at the end of the value chain, which is more to do with the intellectual property or the uniqueness of the asset that the company has. That doesn't really, well, I don't know whether that should have a bearing on how you attribute the actual ultimate greenhouse gas avoided across a lithium miner and an EV producer. Perhaps it should, but yeah, we've not really tried to unpick that particularly. Have you at Net Purpose? I think we've had that conversation. I just can't remember what the outcome was.
Yeah, so I think this is an area of development, and I would say we've taken quite a practical approach to it. And I think the first practical question is, why are we doing this in the first place? What are we trying to achieve? And the typical answer is we're trying to identify companies that provide products and services that solve global goals. The first part of the question is, how do you know if a product or service helps solve the global goal? And that's where we've really dived deep on scientific literature to validate that this product or service has a defensible impact that positively contributes to a global goal. And we can evidence and measure that by calculating outputs and then going to impact outcomes and impact using the scientific literature and the company disclosure. This question of value chain attribution is the next step, I think. And what's very interesting about it is that I think the level of conversation is drastically increasing as the sophistication of the space improves. So we've had conversations with clients about gross and net. Gross impact being the total CO2 avoided from the product or service itself, like across the value chain. Some clients are allocating the portion of the impact across the value chain depending on the value added, like of the actual part of the value chain. And I think that's particularly important if you're investing in multiple parts of the value chain. I I think the other angle that comes in here too, though, is to get back to the original goal, identifying products and services that are positive and measuring their impact. I think we're still at the point of trying to identify and then measure the total impact, and we haven't got and invested the resources to significantly allocate across the value chain. I expect that the methodologies for doing that will evolve quite a lot in the coming years. And I think for now it's good to be aware of it, but I think being transparent about measuring gross, would say, versus net is okay.
Yeah. And the other thing I just wanted to say you made the point earlier on that for a long time people just talked about, you know, it's like positive impact or it isn't. It's kind of a binary question. You're in or you're out, and that was certainly the way that we managed our strategy originally back in 2005 when it was launched at the Henderson, and for the time that I was there, it was really a kind of, you know, you're in the bucket or you're not, and that was kind of the limit of the. We didn't even call it impact analysis. The sort of thematic work we did was, do you get enough revenues from the positive stuff, and do you get no revenues from the negative stuff? Great, you're in, and that was it. And I think, you know, if you're going to call yourself, honestly, if you're going to call yourself an impact investor, you need to get beyond that. That is a level of sophistication. You know, that's like saying, you know, as a financial investor, as an investor focused on profit and loss, you're in profit, right? You're in.
Yeah,
it's so crude. And we have the tools and increasingly the data that allow us to pass across this investment universe and identify more intensely impactful businesses. So yeah, that would be I think, you know, my reflection on that.
Yeah, that makes sense. I also like the financial analogies in multiple of these worlds, in particular with regards to ratings, where I don't think anyone would outsource their definition of financial performance without double clicking on what the numbers say. So just let's pull it back up to where we're going. What are you seeing, Seb, on the standard side, whether it be regulation or, you know, you do mention in your report a couple of major advances and leaps forward. You've just mentioned one, too, the work on CO2 emissions avoided. What are you excited about in measuring positive impact in listed equities? And then we're going to take a few questions, too, on the macro thoughts of how you think about your portfolio from a goals perspective and otherwise.
Well, I think what I'm excited about, you know, genuinely excited about the work that you guys are doing in Net Purpose. I think, you know, we had, candidly, we had a conversation within WHEB about whether, you know, isn't all this our intellectual property? Should we not be doing this ourselves and not getting into bed with Net Purpose? Because, you know, by definition, you want to serve the market. And I think, you know, the answer to that is this is data that is, you know, incredibly important, and our proposition cannot be dependent on this part of our process. You know, we need to be better at finding the highly impactful businesses and generating a good return from that. So I think it's great that this activity is being socialized in the way that you're doing it, and others, and I'm sure that will turbocharge the field in terms of how we kind of resolve these questions about the value chain and so on. So I am genuinely excited about that. I'm also just excited that we're having these conversations, to be honest. I mean, it's great that this question about the value chain attribution, it's great there are people asking questions about baselines. I mean, it feels so sophisticated. It's wonderful. But for so long, it was quite a lonely, you know, are we even asking the right questions? Are we going in the wrong direction here? So it's sort of validating that you know, there are more and more people involved and focused on this, and about time, as you were saying earlier. You know, we've had so long focused on operational issues that it's just great that we're focusing on products and services now, and it's a much easier agenda from an investment point of view, because we want these companies to grow, and we want them to grow their impact, and those two things are absolutely aligned, you know, and they're often not when you're focusing on ESG. So it's a kind of cathartic, and as well as an investor, because you have much more alignment.
I love that, actually. I love the word cathartic. And also love the mental model around having spent so long on thinking about quantifying operations. And now this is an entire domain, really. It's a life cycle domain of everything we've put into the world, from waste perspective and others, but also just a very big meaty topic to jump off on products and services. And thank you also for the kind words, Seb. I mean, I will say that so being an impact and having been an impact investor myself at Leapfrog Investments, I just know the pain of impact measurement. And I do think that when we think about financial markets, there is an entire data industry, a $30 billion data industry that literally exists to support investors to make financial decisions. So every investor in the world can think about analyzing that information without having to compile it themselves. And for us, I think we're just proud to play that role in social and environmental performance and impact measurement. It is a challenging, tedious task to pull all this information together. And ultimately, we need to put that in one place so everyone can use it and start to make sophisticated decisions on impacts, which I'm also personally excited for, and to collaborate on that too. And one topic that has come up in some of the chats, and then I will actually open to more of these topics, is do you... First of all, do you have an impact objective at the portfolio level, or is it only on an individual company basis?
We do, but we have, it's a fairly high level and some might say rather anodyne kind of objective. But all of our, so we have 9 different themes, 5 environmental and 4 social, so they're quite diversified. We all think that they are contributing to sustainability, more sustainable economy. So the language at the level of the fund as a whole is high level like that, which we think is important because there is a unity to it. But more important, really, we think is the theory of change, as we were saying earlier on, the problem statement and the theory of change at the individual level of each company. So we do have an overall sort of banner, but it becomes much more meaningful as you come down into the themes and then into the individual companies.
Yeah, that does make sense. And actually, on that same token, how do you prioritize this question here, or balance impact versus returns? Would you ever sell a company that has had a positive fundamental outlook, but less than desirable positive or negative impact?
Yeah, so it's a question we get a lot. I mean, I think those things aren't, it's more complicated than one or the other. There is a relationship, we think, between impact and potential return. And the way that our impact engine is structured kind of speaks to that a bit. So, for example, we have a question around how unique is the contribution that the company's making. If the company has, very, very few companies are unique, but, if there are a limited number of competitors, or only a few companies can actually deliver this positive impact, we think that's important from an impact point of view. It makes it a bit special. It's also quite important from a kind of returns point of view. It means they've got quite good moats around their business. Equally, that scale point that we were talking about earlier on, if you're delivering an impact, a more, higher level of impact from a baseline, one technology A is delivering a 30% improvement, technology B is only delivering a 10% improvement, then other things being equal, which of course they never are, but for the sake of argument, if other things are being equal, then actually that more impactful business should do better because its technology is likely to be more attractive to clients. So there is some overlap between impact and a kind of commercial reading of likely performance. The thing that isn't really aligned here is valuation. So you can find the most wonderful business in terms of the impact that it delivers, and we give it a very high impact intensity score. We give it a very high quality score for the way that they manage their operations and their competitive position and so on. But if it's valued at some ridiculous multiple, then while we love the company, we can't love the equity because we're not going to be able to make money. So there is a third dimension here around valuation that we also have to pay attention to, which means that we can't just invest in the most impactful, best companies, irrespective of the valuation that they're trading at.
Yeah, makes sense. You are an investor at the end of the day,
yeah.
and you're the holder and manager of your client's capital. And actually, to that degree, there was another question about the role of institutional versus retail investors and their interest in positive impact in listed equities. Could you offer any thoughts on that with regards to your client base? Do you see more interest in one or the other?
Yeah, that's an interesting question. I mean, I think probably at some level, retail investors are just get it more intuitively. You know, they're less sophisticated, they're less versed in the ways of financial markets, and they just want to invest in companies that are doing good things and don't want to invest in companies that are doing bad things. That's kind of, I think, maybe I hope I'm not being patronizing, but but I'm thinking about, my mum, for example, who invests in our strategy. That's kind of what she wants. And then as you become more sophisticated, the more you're thinking about additionality and these other kind of concepts, and you're thinking, well, actually, I can't really see the change that I'm going to deliver as an investor in listed equities, and so maybe you become less keen. Which I think is as we were saying at the beginning, if you really want to have impact, you're going to have to embrace it in listed markets as well. So I think there's probably just sometimes the kind of the received wisdom can get in the way of putting capital to work in ways that will generate impact.
Fabulous, Seb. I think there's a couple of others here that first one for you, and then I might wrap up on one last one. So one for you is very concrete. Do you have a revenue threshold that you set in your impact engine for looking at positive?
Well, we set it for the universe that we have. So the investable universe that we create, you have to have at least 50% of your revenues coming from positive impact areas. And then obviously we have negative criteria on the amount of revenue you can get from negative areas like fossil fuel production and so on, and that's 5%. In practice, nearly 90% of revenues to companies in our portfolio come from positive impact areas, and literally nothing from oil and gas exploration, production, nothing from refining, nothing from those sorts of areas. But so we set the threshold at 50%. It used to be 33% actually, but the market has evolved to a point where actually there's there are quite a lot of companies that get more than 50% from positive impact areas, but it's still, sometimes you'll find a business that's got a really interesting growth area and it's only 50%, and the rest is kind of neutral, as it were, from an impact point of view. And you don't want to be prevented from getting into that company until it's 80%, because then you may have missed quite a lot of the upside. But yeah, so that's the threshold for us.
Fabulous. I think that's going to be really informative for people thinking about implementing a methodology and an approach. And maybe just one meta question that's come through, and maybe a good place to wrap. I'm always in favor of ending a meeting early because everyone's got to get to the next one. So the question was really around mainstreaming impact and positive impact investing. And I think the particular question was framed as, we've got a lot of ESG indices out there. So companies that perform well on ESG ratings will have an easier time attracting visibility of investors because the methodology is reasonably established. Whereas it feels like this could be a bit more bespoke. And how could a company actually that is providing positive products and services be identified and become visible to investors? One thought on this, just from my side, is we are moving to a deconstructed way of thinking about positive and negative impact beyond, I think, ESG. And I think there will be in the future multiple indices or methodologies created to select and identify companies that fit your individual investment strategy and individual sustainability or impact preferences. I think we're on that train and we're moving in that direction. And so I would say for now, there are a lot of impact investors out there like WHEB, Seb, many others trying to identify and doing a lot of work to identify and invest in companies that are providing positive products and services. And I do think that this ultimately, if we can identify those in a systematic way, we could, just like you construct a universe, think about constructing portfolios of positive impact that help more and more of those companies become identified. I'm going to hand over to you for one final word, Seb, before I do, just say to everyone listening, we hope you've enjoyed the chat. If you have any questions coming out of this, any more questions for Seb or myself or anyone around this table, please send them through and we can pass them along. If you need support on measuring impact in listed equities, Net Purpose is available to support, and I'm sure Seb potentially and others are available to provide advice. Please let us know. And really excited just to start this conversation and to elevate it over time. And this is not the last time that we'll be talking about this topic or different sub-segments of it, but really excited. And I've learned a lot today as well. And before we go, Seb, I might just see, do you have any final closing thoughts to share?
I think just one final thought. I mean, I think, and partly it addresses the point that the question was just making about these companies and how we make them visible. You know, I think we see ourselves very much as part of a movement at WHEB, and we think that the more this ecosystem grows with, you know, data providers like yourselves, investors like WHEB and others, and companies presenting information that allow them to be identified as delivering positive impact, is a very fertile and rich kind of ecosystem that we think will feed off itself and build momentum. And it's all about creating as large a movement as we can to get impact investing into as much of the market as we can. And you know, obviously we've got a long way to go, but I think it's an exciting time to be involved. So thank you very much for the chance to talk about it.
Thanks so much for joining me, Seb. And thanks to everyone else for joining us. Really appreciate it. And stay tuned for the next one. Be in touch.